Hello and welcome to Cedar Trades, and today we're gonna be talking about what most might know as the quarterly theory, and we actually gonna be talking about the origins or looking at the first guys who actually spoke about this thing. Yes, ICT actually said a lot about this, and there's trader Daye right now, who recently also introduced it as the quarterly theory. But if you kind of look at it, it was given by ICT in the form of seasonals, and he basically said you can every season the market makes a change in direction or a shift in a structure as a whole. So looking at that, he also said what happens in the bigger time frame also happens in the smaller time frame. So if you were actually able to listen, I think you might agree with what we're going to be talking about here. So I would like to call this the Fibonacci quarter based trading strategy for something that I'm about to give out right now on YouTube, because most people want to know, okay, what's the strategy name? For me, I like this, the Fibonacci quarter based, because it's simply telling you about the Fibonacci first. Even if you look at ICT's logo itself, this is kind of like a Fibonacci, or let me say the golden ratio, because the golden ratio, the spiral, everything falls back into this. Everything is in here. So now that we are done with that, let's move forward with the lesson. So the quarterly theory explained. The quarterly theory is a structured approach that divides a trading period into 4 distinct quarters. Year turned into 4 seasons, or 4 quarters would be 3 months each. Then we have 3, 6, 9, 12 months. That makes up a whole year. So every quarter in a year, or looking at the yearly cycle, then that means we're gonna have 3 months making 1 quarter. The other 3 months, which means January, February, March is our first quarter. April, May, June, that's our second quarter, so on and so on. In our month, I'm gonna explain everything in full on another slide. Sorry, I know some of you might say, okay, I wanna understand the whole thing. I'm still coming with that. I want to actually give you the whole thing so that you sit in a bigger frame. Then we go smaller and smaller while we explain it along the way. So the monthly cycle has 4 weeks in it, so every week is a quarter. And if you think about it, imagine a whole cycle, or for you to have one full thing, you actually need 4 quarters. If you have 5 quarters, that makes something bigger than one. So if we were to say put you in front of yourself and say I'm gonna cut myself into 4 pieces, right? You would have your head, you would have a part that's by where your chest ends, that's the 2nd quarter. Then cutting your knees, that's your 4th quarter, to your legs, that's your 4th quarter. So your knees 3rd quarter, your toes down there, that's you as a whole, or you as a finished product. Yeah, let's just say that I'm trying to give you something realistic for you to look at it, because you have to get into your mind and think about all of these things. Okay, if I'm having 5 quarters, that means it's an overload. That's an bought or oversold situation as well. If you have something that goes off the 4 quarters, then that thing is unbalanced in a way. It's bigger than one. It's giving off a little extra piece at the end. So every month has 4 quarters. Each week is a quarter. In a week, we have 4 quarters as well, which means from Monday to Thursday. Monday will be your 1st quarter, Tuesday your 2nd quarter, Wednesday your 3rd quarter, Thursday your 4th quarter, and then Friday will have its own function. And what it does, it simply continues with Q4, or what Q4 did. We are gonna be using that data to determine the trading in Friday. And your daily candle, I am in South Africa, by the way, so for me to look at this, it's so easy for me to divide the whole day, because the trading in South Africa actually opens up when just after that time period the market closes. So you get that sometimes it closes by 10:30 in South African time, PM, 10:30 PM, and then at midnight it opens up. So midnight, it actually goes from midnight to midnight. So if I want to chop up a whole full day, what I would do is that one full day, I'll say divided by 4. 24 hours divided by 4 gives me 6 hours. So 6 hours in each cycle. 6 hours my first cycle, 6 hours my second cycle, 6 hours my third cycle, 6 hours my fourth cycle. And remember, we need 4 quarters to make a full range, or a full cycle, or one full whole thing. And even single candles, for example, like the 4-hour candle can be divided into 4 1-hour candles. 1 minute candles can be divided into 4 15-second candles, each with specific phases and strategies, leveraging time-based Fibonacci levels for optimal trade decisions. So the tools used to look at this, I understand that when we talk about Fibonacci, most people know the Fibonacci retracement, but think about Fibonacci measuring time, because most people don't want to look at the fact that you can't be trading at all times. Yes, the market is opened up for you to trade, but the minute you organize yourself, that's when you actually start seeing the change developing in you as a trader. So now think about this. The chart has the x-axis and the y-axis, and if most of you still remember in school, x is the cause and y is the effect. So we have time and price, right? So most people just look at price and actually never minding the time, because since it's open for us to trade at any time, why not do that? But that doesn't organize you as a trader, and you actually you see your own account slowly dying if you do not organize all these things. So in trading view, we're gonna be using the trend-based Fib time, and the trend-based Fib time is a trend-based Fibonacci time analysis that involves using Fibonacci ratios to identify potential time reversals within each significant price movements or trend changes may occur. While traditional Fibonacci retracement levels are applied to price movement, Fibonacci time analysis applies the same principles to time intervals. So this means that there is actually no difference between your time and price, because the same principles that we are putting in the range as a whole in time, that okay, if we take our Fibonacci from a low to a high, then we can get to see our 50%, we can see our 75%, we can see our 25%. Take that now, put it in time, then it will simply show you what I was talking about, where we can measure a year into 4 quarters or a day into 4 quarters as well. So we're gonna have examples that are showing these things, and now let's get into this. So this is called the Gann box. Gann box, also known as a square or the Gann square or Gann grid. It is a technical analysis tool developed by the legendary trader W.D. Gann. It's based on the principles of geometric angles and squares to analyze price movements and forecast future price levels. But right here in this lesson here, we're not going to be talking about the geometric angles and squares and whatsoever. We're going to be using the Gann box to actually measure a time period, since time is predetermined. That's the other thing I want us to look at. If we look at this, the calendar, right, you see that there's the news is actually pre-planned, so you can get to see what's gonna happen on the 17th, or let me say 18th of November 2024, right? That is already pre-planned. Everything is already in the marketplace. The market already knows where it's gonna be going. So let's say we are trying to organize all these things and have it in a space where we can say, okay, so on this day this and this can happen, on this day this and this can happen, because you are organizing each and every day. And since the market repeats itself, it means whatever it might do on Tuesday on today's Tuesday, whatever it might do today, it might do as well on the following Tuesday, or on that other Tuesday, or that other Tuesday, or that other Tuesday, because it simply knows the data. It's like a program that's actually set to happen. So if Tuesday is showing some sort of things, right? Let's say it's looking at this two news events right here, right? It's gonna make sure that price in all this time, or the time before this, it's actually planning up for all of this right here. Since everything is predetermined, it actually knows what's gonna happen on the 25th of December, on the 26th of December, on the next year. We are not given that data, but this thing as well doesn't change, so we can simply look at the whole year and get the sense of the following year. But the only thing that happens is the days now change because of the weekends and everything that we had this year, and the following year they're gonna be quite different in a way. So this, we're gonna be simply putting our 25%, our 50%, our 75%, and our 100% same into this. Remember, we are using the quarters, so quarters are simply 25, 50, 75, 100. There is nothing too complicated into this. It seems like it's a lot, but truly speaking, it's not a lot. A lot is not enough. Let's look at how the whole thing works. So remember, while selecting the Fibonacci time intervals right here, you apply Fibonacci ratio. So you determine where your day starts, where your day ends, right? That's selecting the time intervals. So it's point A to point B. Your full day has point A, point B. But in point A and point B, there are some other points that are there in these spaces here. So this is where you apply your 25%, your 50%, your 75%, and you kind of like measuring your whole day. And since you see this measurement, this can literally be applied on the next trading day to get to show you that, okay, so this time makes price movement like this, provides price movements like this, the third cycle provides, okay, most of the time huge movements, okay, the fourth cycle, it's either continuation or reversal. So the same thing is applied to all the quarters. So your yearly quarters, your monthly quarters, your daily quarters, your candle quarters, because even your one single candle can be divided because it's time, and you can find point A to point B in time. You always start by 0 and end up by 0 in another way. Because if you want to find 1 full minute, you start by 000, then it will go to 25 seconds, then it will go from 000, then it will go 15 seconds, then it will go 30 seconds, then it will go 45 seconds, then it will go 1 full minute. Now we chopped out a 1 minute candle into 4 quarters. So this thing can be applied to candles as well. Each and every single candle here, this is like you looking at the power of 3, if most of you know it, that says a candle opens up here, makes a shoot down low here, then makes the high, then close up, then does a buying candle. Most of the time a selling candle is open, it makes the high, it makes the low, then it closes lower than the open. This is a buying candle. So open, high, low, and close, and open, low, high, and close. So that's the difference between the two candles, the buying candles and the selling candles. So we simply add the quarters, which is our first quarter here, 0.25, 0.50, 0.75, and 1 as a whole. We apply this to time intervals, so from point A to point B, rather than price levels from point A to point B. So we're applying the Fibonacci in time rather than price levels, and these ratios represent potential time intervals where significant price movements or trend reversals may occur. So if you are able to study that, okay, so maybe Q2 or Q3 most of the time starts your trend reversals, then this is gonna apply to whatever time frame you are looking at, whatever candlestick you are looking at. This theory here will be there as well. So projecting time extensions, Fibonacci time extensions can be projected from point A to point B. For example, at the beginning of a new day to the end of it, in easy terms. In easy terms, at the beginning of a new cycle to the end of it, to estimate potential future time intervals where a trend occur, may continue or reverse. And we confirm with price analysis. So this analysis here is mostly used in conjunction with price analysis to confirm potential turning points. To confirm turning points or trend continuation zones. Overall, trend-based Fibonacci time analysis is a tool used to identify potential time-based support and resistance level, helping you anticipate significant price movements or trend changes. And the Gann box. The Gann box is used to identify the time range. So we identify the time period you want to analyze using the Gann box, such as a day, week, or a month. Divide the time range into 4 quarters here. So we divide the time range into 4 equal parts by adding vertical lines here at 25%, another vertical. So this whole box here, right, is one box. I'm gonna show you later. It's just one box here. It's not this box and this box and this box and this box, but this is one box where we divided the 25% of this time from point A to point B, right? So we are simply adding vertical lines at 25%, at 50%, at 75%, and one whole of this time range. And these lines represent the boundaries of each quarter in terms of time. So this will be our first quarter, our second quarter, our third quarter, our fourth quarter, right? So once you've divided the time range into 4 quarters, you plot the Gann box on the time axis of the price chart, ensuring that the grid lines align with the quarter boundaries. So from point A to point B, once you in the settings divide the quarters in this, right, it's simply gonna show you all this data. It will just be one box that will be showing you this whole data in here. So then with that, you analyze time-based price movements. With the quarters marked on the Gantt box here, you can now analyze how price movements correspond to different time intervals within each quarter. This analysis can help you identify potential turning points or trend continuation zones based on time-based patterns. So here, since you are measuring one full day, right, if you gather up enough data and you are able to see that, okay, so in the third quarter, some kind of pattern repeats itself, you'd wanna do this the whole time so that you know where your third quarter in the day is, so you can look for that pattern you look at in the third quarter, right? So this analysis can help you identify potential turning points or trend continuation zones based on time-based patterns. And by putting quarters on the Gantt box in terms of time, you can gain insights on how price movements are distributed over different time intervals within a trading range. This can help you anticipate potential changes in market dynamics and make more informed trading decisions. So here's the quarters explained here, right? So in here, this is simply measuring one day. If you can look down here, you can see it says what do you call it, Monday 27 May midnight and Tuesday 28 May midnight. So I pre-planned this video, but I got lazy and I was delaying the recording of it and everything. But this I planned it like 2 days before the 27th of May. So if you look at the whole day, right, your whole day is now divided into 4 equal quarters. So this is equal to this, and this is equal to this, and this is also equal to this. So they are all equal, and the same, this quarter can be divided into quarters as well, and this quarter here can be divided into quarters as well. So it means from here to here, it's also a quarter in a bigger frame. And now this is only an explanation inside that one full thing here. So from A to B, this is one thing. This is one day. This is 1 month. This is 1 year. This is whatsoever you might want to look at it. But right now we are simply looking at the days only. So if you look at it, your day has the Asian session, your London session, your New York AM session, your New York PM session, and your Asian session most of the time is accumulation. There's your manipulation, there's your distribution, there's your reversal and continuation. And it's just like how you can see it here. Accumulation, it manipulates to the upside, then it starts distributing, and it continues, then it reverses. So all of these things are organized. Accumulation manipulates to the upside, then distributes in the third cycle, fourth cycle continues and reverses, right? So that is that here. This is simply 25% of the day, which is 6 hours, 25%, 6 hours, because a day will always be 24 hours. So if you chopping it up, it's gonna be 6 hours times what, times 4, and you actually find the 4 quarters of the day. So it'll be your accumulation, your manipulation, your distribution, your continuation or reversal in the fourth quarter. So this may be Monday, Tuesday, Wednesday, Thursday, or it might be the first week of the month, second week of the month, third week of the month, fourth week of the month. It might be the first season, second season, third season, fourth season. So it's all one thing. There is no difference in all of these things. They are simply one thing that if you look at, they all complete one another. So without the other, there wouldn't be the other one. So they all need each other in a way, we can say. Now, looking at this, the accumulation or your first quarter, your Monday, your Asian session, your first week, your first 3 months of the year, it's observation and initial market sentiment. This has the same function as like I said, your seasonal tendency, your first seasonal tendency, your first week in a month, your Monday, your first 90 minutes in every session, because in each and every 6 hours, if you want to find quarters of 6 hours, it's 90 minutes, which makes 3 hours, because it's 1 hour 30 minutes, 1 hour 30 minutes, 3 hours, 1 hour 30 minutes, 1 hour 30 minutes, 6 hours. Now this second quarter marks your true open, or it's used for true open identification for market manipulation. This has the same function as the second seasonal tendency, your second week in a month, your Tuesday, your second 90 minutes in every session, all the way down to the second 15 seconds in a 1 minute cycle. Your third session, you'll be looking at trading based on the true open identification. This has the same function as the third seasonal tendency, the third week in a month, Wednesday, your third 90 minutes in every session right here. Your fourth session is used to evaluate trend continuation or exhaustion. So this has the same function as the fourth seasonal tendency. The fourth seasonal tendency, fourth week in a month, Thursday, your fourth 90 minutes in every session as well. So simply first quarter, second quarter, third quarter, fourth quarter, first season, second season, third season, fourth season. Then it repeats. It simply goes back to this, because accumulation starts everything. Okay, so here we're gonna be looking at how the indicators work, and we're gonna be applying them on our price charts. So for this day, right, which was yesterday, the Monday, so I'm gonna do this day and today as well, which is the 18th of June, and I'm gonna show you how this day is organized, how this day was organized, and maybe we'll get into this day using the two indicators that I was talking about. So first thing that you want to determine is your point A to point B. So for me, right, or for everyone else who lives in South Africa, you can simply look at your midnight to midnight time, because your day is simply organized or organizable into 4 quarters on its own. So where your day begins and where your day ends, where your day ends begins a new day. So here we were talking about the trend based Fib time here, and we're gonna drag that from we're gonna put that on point A to point B here. Then it's gonna put in, if you click one more time, it will show you the quarters for the next day. So let me remove some of this. We're gonna talk about them on some other videos. This is the golden ratio. You can add the golden ratio and everything on this. So looking at this, we have your first quarter here, your second quarter, your third quarter, your fourth quarter. So your accumulation, market manipulation, your distribution, your reversal or your continuation. And this again is your 6 o'clock price. Sorry, so let me do this. 25, your 50, your 75, and your 1. These are the settings here. So 25%, 50%, 75%, and 1 as a whole. Right, so you see that sends us to what? 6 o'clock, 12 o'clock, 6 o'clock, 12 o'clock. And now this is the day measured into 4 equal parts. There is no quarter that's bigger than the other. They are all equal in time. So from here to here 6 hours, from here to here 6 hours, from here to here 6 hours. And then now if you use previous days data, right, you get what do you call it, the recent days data price movement. But if you wanna study, right, if you go from point A, let's say you wanna put these lines on this day here, that's already done with. You go from point A here to point B, then you drag it again like this back to point A. Then it divides the whole day for you again. So if you look at it as well, accumulation, manipulation, your distribution here. Same thing that we've been seeing on all the other examples as well. So this, and if we look at it, let me add the Gantt box from point A to point B right here. Then in the settings, you have to switch off the others, or switch off all of them, all of your time levels, switch off all your price levels, and on your time levels put on 0, 1, 25%, your half, your third quarter here, which is your 75%, then press on OK. Then it's gonna give you something like this. And if you measured a full day, right, it's gonna give you your 25% of the day, your 50% of the day market manipulation, your 3% of the day, your third quarter, your fourth quarter as well here. And this thing, the Gantt box, can also be applied like this. So in this range, I can go and apply from point A to point B, which would be the 6 hours in here. And then I can go add the other 6 hours here, add the other 6 hours, add the other 6 hours, and there. Then I get to know the quarters in this quarter. And with the same thing as well here, you can also add this into that, because it's simply measuring the quarters. And since your settings are to measure the quarters in that thing, right, this right here is simply measuring the quarters in this quarter, which is this quarter as well. Now this as a whole is probably a quarter, and if you look at it, it's Monday, so it's the first quarter of the week. It's actually this whole price movement is just the potential accumulation in here. And then the same thing here is there as well, if you look at it here with this one. So I can go from point A to point B, then it will divide this quarter for me here, or I can drag it back to A and it will divide this for me here, and I can simply keep adding them into these quarters here, point A to point B, 6 hours, then back to point A to point B, then back to point A. So if you look at it, right, here my accumulation, manipulation, distribution, then continuation, reversal. In here it's Q2, so we are looking for manipulation, but if you look at it, there was accumulation here, manipulation to the downside here, then distribution to the upside. But this distribution in here is in a smaller frame. This whole thing here is manipulation here. And then in the third cycle, we look at accumulation, manipulation to the upside. You can see it accumulates here, manipulates to the upside. It's in the third quarter where you're looking for distribution, but in that distribution there is also accumulation, manipulation, distribution, and a continuation and reversal. So here we've had this accumulation here. Let me add it on. So we had this accumulation, we had this manipulation to the upside, then we had this distribution. Now if you look at this, there's a video that we're gonna get into later on in the videos, or in what I'm gonna be giving out. there is what's called the market maker models, and this right here is the smart money reversal pattern right here, where they kind of reaccumulate orders in here in the distribution and then send them down. But if you look at this now, while this was distributing orders, it wasn't making any price movements, but it was simply going back to PD arrays or your support and resistance levels. But if we are looking at PD arrays, then it simply means we'll be looking at what you may know as your fair value gaps. Right here is one fair value gap right there, or your inverted fair value gap. There was one here. I personally love inverted fair value gaps because think about it, there are order blocks everywhere, there are fair value gaps everywhere, and the same thing happens with the whole PD array. So instead of me using them as what they are for, I can use them as inverse what do you call it, price patterns. So let's say this was gonna be an order block for some people to buy at, because okay, let me fix this up first, because people have the mentality of, okay, I'm gonna buy by this order block, but the minute it breaks it right here, looking for what do you call it, a move after this break here and the retest on this breaker, now this order block here becomes your breaker block, right? So from order block it goes and becomes your breaker block right there. And 50% of your breaker block, you want to see what happens right there. So if there is some rejection on your 50% of your breakers and your order blocks, that suggests some strong price movement. The same thing as well applies when you are looking at fair value gaps. So your 50% of your fair value gaps and order blocks, things like that, that is very important. So I'm gonna mark this fair value gap right here, and we get to look at 50% of this fair value gap. If you can look by the 50%, there was some rejection going on right there, and then the fourth cycle that's known for reversal is here to reverse this whole move that we had here. So accumulation, manipulation, distribution, continuation, and reversal, or reversal here. Then it accumulates, it manipulates, it distributes, it continues, and reverses as well. So if on this day right here, let me add this. This is 6 hours as well. It accumulated, manipulated to the downside, and then distributed, continued, then reversed. And we can go on and on with the 6 hours. I can keep on just adding this in 6 hour periods, 6 hour periods, 6 hour periods, or I can simply just, what do you call it, look at it in a bigger frame like this. Because what we're doing right now, we're adding the smaller frames into the bigger frames. So we're doing this in this cycle here, we're adding quarters in there as well, and it will show us the first quarter, second quarter manipulates, it distributes right here. And if you look at it right here, this was the same thing that we had on that other price right here, where we had the third quarter, in a third quarter falling into a fair value gap right here, rallies into a fair value gap, maybe your breaker, and a lot more things, because I've noticed that if it's the right time, there are usually a lot of things to look at right here. Right now we are just looking at a 15-minute time frame, but you can look at your higher time frames, your weekly down to your 4 hours, even your monthly time frame, your yearly time frame, just to look at how everything is going on in there. That is also advisable. But now, if you are setting up things like this, then you get to find your price points where things might start moving, because here you'd be expecting some sort of reversal of this whole move that was here. Then that's what's provided here: accumulation, manipulate to the upside, there's highs, then distribute, then what do you call it, reverses here. Then this again has the same thing in play right here. Your accumulation, we need manipulation, then distribution. And right now, if you look at it, we have news coming in at 2:30, which is 8:30 New York time. That's gonna be in this quarter right here, which is the manipulation. So it's accumulation, manipulation, and it's gonna be where the news is. So the news is gonna be manipulation. So every time you see your news in 2:30 or 8:30, just know that it's falling under manipulation. And then comes your third quarter, your distribution, and your continuation or reversal in there. And sad to say, this is the end of the video. Thank you for watching. Please subscribe for more content. I'm for sure gonna be making more videos and uploading more. And good luck and good trading.